Good morning, everyone, and welcome to Moneycorp's Market Pulse webinar. I'm Neil Parker, Head of Economics and Market Strategy here at Moneycorp, and I'm delighted to be your host today. It's October, the season of ghost schools and economic deja vu. In keeping with the Halloween spirit, we've themed today's session The Ghosts of Markets Past, and we're going to explore how economic memory, shaped by previous economic cycles, may be haunting effective decision-making in today's uncertain environment. Now, during the session, you won't be able to use your audio or video, but you will be able to post questions in the chat box. So please do this throughout the session, and I'll try to get through as many questions as I can towards the end. But let's delve straight into the presentation. And as I say, it's themed Ghosts of Markets Past. So what we're going to walk through is we're going to look at growth. We've had some updated forecasts from the International Monetary Fund, so we'll look at those. Then we'll look at inflation. Inflation's a particularly hot topic at the moment in terms of driving interest rate decision making. We'll move on to interest rates and where things are likely to head into the year end and through 2026 before moving on to fiscal policy, big events coming up over the coming weeks. And of course, we've also got the US government shutdown. We'll look at geopolitics as well, because we have had some developments there. Finally, moving on to FX forecasts. And after that, a summary and then the Q&A. So hopefully that'll be of interest. And as I've already mentioned, do be sure to ask your questions in the chat box. So growth, where are we on that? Well, it's been a disappointing year, I think, for 2025 for most economies, made all the harder because of the Liberation Day tariffs announcement by Donald Trump, and that definitely saw growth forecasts revised down. But I'm encouraged to say that quite a lot of growth forecasts subsequently have been revised up slightly, and so it does appear, at least on the surface, that those tariffs aren't having as negative an impact on a number of key economies versus expectations. If we look at global growth, or global growth expectations are up 0.2% for 2025, but unchanged to 2026. If we look at some of the other major economies here, US growth is expected to be 0.1% stronger than the July estimates from the IMF for both 2025 and 2026. The UK growth is expected to be up slightly more in 2025 than previously expected, but then that's taken off of the growth forecast for 2026. And in the euro area, the growth expectations for 2025 have been revised up by 0.2, but in 2026 down by 0.1. So there are lots of things to unpack within that. I am somewhat surprised by the revisions to the growth forecasts, only because given the weight of monetary loosening that we've seen from major central banks and central banks around the globe, I would have expected that growth is likely to be faster into 2026. And there was an interesting comment from ECB Chief Economist Philip Lane, where he said that perhaps some of the transmission is being disrupted by uncertainty, whether that's geopolitical uncertainty or economic uncertainty and domestic political uncertainty. So perhaps that's something for central banks to explore as we head into the end of the year and beyond. Now, if we move on to where we see things moving for inflation, well, again, it's been a challenging year. Inflation has been picking up across a number of major economies, apart from the Eurozone and Canada, where we've seen Canadian inflation well anchored around its target level, and the European Central Bank have been quite aggressive on reducing interest rates because of how well managed their inflation rate is as well. But for both the UK and the US, we've seen problems. US inflation has been persistently above target, and in the UK, we've seen a recent surge in inflation rates, taking us close to, but not to, 4% on the headline rates. And the right-hand chart here is interesting because what I've done is I've indexed that to January 2020, so effectively the onset of COVID, and seen how inflation and prices have moved subsequently. And this demonstrates that anchoring of Canadian prices. So Canadian prices have risen by the least, followed by quite closely behind one another, the US and the Eurozone. But it's clear that the UK has experienced more inflation than other economies, and that may be a limiting factor for the central bank moving forward. Certainly the Bank of England and members of the Monetary Policy Committee have been loath to reduce interest rates more aggressively based on the overshoot that we're seeing in headline and core inflation. So if we move on to interest rates and where they may be heading over the course of the next year or so, we've got the Federal Reserve meeting next week, and they're very, very likely to be reducing rates at that meeting, albeit that we do have the inflation data for September due for release on Friday. So that could still change the outturn as far as that Tuesday and Wednesday meeting is concerned. But it's broadly speaking a dead certainty, according to market probabilities, that the Fed will reduce interest rates by 25 basis points at that meeting. And then again in December. Of course, with the government shutdown, there's no data to really back it up. They've had to bring the Bureau of Labour statisticians back in, especially so that they can produce the September inflation numbers. And so with that hold on a lot of the economic data, the Federal Reserve are becoming ever more reliant on their own assessment of economic conditions, or the Beige Book. And that did demonstrate that there is still some weakness in labour markets, still some weakness in other markets like the housing market, and retail is also a very uncertain picture given the government shutdown and what that might mean for the pay for hundreds of thousands of government workers. As for the Bank of England, as I say, they're not expected to cut interest rates at the upcoming November meeting, but they may well cut interest rates now before the end of the year. And that's after today's inflation release, which showed not only headline inflation not picking up to 4% as expected, but also core inflation rates falling. And that's also critical because a lot of what goes into things like pension calculations for the state pension, things like the national living wage and how much that might be uprated by, a lot of things are governed by those September data. So that's good news as far as the Bank of England's concerned. And I think that we will see that feed through into expectations of either a cut by the end of the year or potentially the first interest rate 2026. The European Central Bank, that one, we thought they were done as far as interest rate cuts were concerned. They've been very aggressive. They've taken rates down from 4.5% to around about 2.15%. So we thought that given where inflation is, which is currently around 2%, there's probably not that much room for maneuver as far as the ECB is concerned. But the door has been reopened. Maybe it's only slightly ajar, but we think that the European Central Bank might be loosening monetary policy again, probably not this year, but into first, second quarter of 2026 looks more likely. But it is data dependent, as a lot of ECB officials have told us. And we think that it will be limited as well. So not as much easing from the European Central Bank as we're likely to get from the likes of the Federal Reserve and the Bank of England. And then finally, if you look at the likes of Canada, I think there's room for at least a further 50 basis points of easing from the Bank of Canada, given how well anchored their inflation numbers are, and also the weakness that we've seen in growth and the increase that we've seen in unemployment. So if we move on now to fiscal policy, and this is causing a whole host of trouble for governments across the West. So I'll deal first and foremost with the US government shutdown. Doesn't appear to be that much impetus behind a deal, that either being a comprehensive deal around the budget or even stopgap funding measures. And so this shutdown could last longer than the previous shutdown under Trump, which lasted 35 days. Some headlines in the press and particularly on Bloomberg talking about it stretching beyond Thanksgiving. Now that could be critical because that will then be a key retailing period that it moves beyond. Black Friday sales could be downwardly affected by the ongoing government shutdown. One other point to note, as far as the US's fiscal issues are concerned, currently have outstanding debt at around $37 trillion. And at its current pace, it will double in the next 10 years. If you look back, for example, to the numbers over recent decades, then it doubled in around 8.5 years post the financial crisis, and then it doubled again in a further 10 years after that. So it's a fairly repeating pattern. Now, the worrying thing here is, based on their current rates of GDP growth, the US is likely to see their GDP double only in around sort of 24, 25 years' time. So debt doubling every 10 years, GDP doubling every 25 years, that's not a sustainable position. And in the UK, a similar problem. Spending is increasing faster than tax revenues. So the UK doesn't have a tax problem. Tax revenues in the latest figures rose by about 7 billion on the same period a year ago, but spending rose by over 11 billion. And quite a lot of that was down to the significant increase in debt funding costs. So this budget coming up on the 26th is going to be absolutely critical as far as the government is concerned. They not only have to convince everybody that they've got a handle on the growing chasm in their public finances, so they have to close that black hole, but they also have to demonstrate that they're able to get to grips not only with increasing taxes, but also making efficiency savings and reducing spending in areas where they haven't pre-committed to increasing it. Aging populations, poor productivity growth, all of those things are a problem throughout the West, and we're seeing that play out in issues around France with their public spending woes, and we've seen it in Germany in terms of that the German government is now taking the handbrake off of public finances and public spending in order to try and trigger a recovery in economic activity. So fiscal policy a problem for all, but a particular problem as far as the West is concerned. Moving on. Geopolitics. Well, we've seen some improvement in the geopolitical situation recently. So we saw a thaw as far as the position between Israel and Hamas, albeit that the ceasefire at the moment is a very tricky one, and we have seen some breaches of that ceasefire on both sides. But hopefully that will hold, and it might provide a blueprint for a ceasefire between Russia and Ukraine, either before the end of the year or into early 2026. That said, both sides at the moment don't appear to be moving closer to a ceasefire there. So that still presents some economic uncertainty along the euro, sterling, and other major Western currencies in terms of their support for Ukraine over Russia. There have been concerns about Argentina's financial position and also their currency, and that's seen the US Treasury provide a $20 billion support funding line for them. So eyes and attention will be focused on that. Argentina hold the dubious record of being the most defaulted country in the world in terms of the number of times that they've had to default. So they would prefer not to see another default in the region, and it could have a negative effect more broadly on Latin America if it were allowed to escalate. And then finally, and probably most importantly in terms of from a geopolitical and market risk perspective, you've got China and Taiwan, or China actually in quite a lot of the countries around Southeast Asia. You know, that situation, the ongoing issues there with regard to diplomatic breeze between the two sides could be problematic and could generate, again, more uncertainty for financial markets. So we're keeping a very close eye on that into 2026. Now, as for FX market forecasts, I am not as optimistic as many in the markets. I've looked at the sort of consensus that we get out of Bloomberg and Reuters, and many are looking for the dollar to continue to lose value. I don't think that that's the case. I mean, yes, there are risks that we see the Trump administration continue on its path with regard to tariffs and also trying to talk down the US dollar. But the economic reality is that the US economy is performing better than virtually every other Western economy and has continued to do so even throughout this period of instability driven by tariffs. So I am somewhat concerned that the markets may be placing too much attention on what is said rather than what's actually happening macroeconomically. So I think the risks heading into the end of the year are to the downside for things like sterling dollar and euro dollar, and potentially some small upside risks for things like dollar Canada as well. Possibly the only currency that might benefit over the course of the remainder of this year is the Japanese yen. It's been under pressure for quite a lot of time, and I think it might get some alleviation of that pressure with the new Prime Minister having been sworn in only days ago. I think if we look into 2026, there is a more general theme here that even with US interest rate cuts, and I think there's probably too many priced in by the financial markets, that the dollar may well bounce back, having lost a lot of ground over the course of 2026. So just watch out for that. I think the dollar is likely to mount some sort of comeback going forward. And then there are other risks. Well, unless we see a material turnaround in the Canadian economy, although we've got some upside potential for the Canadian dollar, I think there is the risk that it underperforms again, and I wouldn't rule out that it moves actually higher towards recent highs at around 148 rather than lower towards recent lows around 137. So, in summary, what does this all mean? Well, I think we have seen clients delaying hedging decisions because in the past, sterling dollar was higher, sterling euro was a lot higher, spent quite a lot of the first half of the year above 120. And that may be, as I say, delaying those decision-making processes because people are hoping for it to move higher. I'm not so sure that we will see that. And given that we've got momentum behind the euro economy, much more so than we've got momentum behind the UK economy, because of the amount of interest rate cuts the European Central Bank sanctioned, that could play out into a stronger euro into 2026. So those hoping for sort of 116 and higher than that do have to face the economic reality that the UK may be the economy that underperforms, even with a pickup in economic growth rates versus where expectations are. It'll be a relatively small pickup for the UK, a larger potential pickup, I think, for the Eurozone. I think markets are also running elevated risks, and that's not reflected in higher levels of volatility because at the moment, everybody is worried about everything. There isn't a one economy that we can point to and say that things are performing better than others. There's risk everywhere that we look. But I do think one other factor to throw into the mix here is that a lot of people focused on interest rate differentials over the course of 2025, and I think they'll play a lesser role in 2026 because there will be some closing of the gap there. Finally, just on that summary, I would highlight that it's relative growth. I mentioned it just now, but it is relative growth that could prove more decisive. I think inflation rates will come back down as well. And so in terms of a trigger to look for, we might be looking in a different direction to where we were back in 2025. So that's it. Just one final slide, which also includes our disclaimer. Don't miss out that disclaimer. Very, very important. And we'll move on to Q&A. So I'll just open the Q&A session, and we have a couple of questions here. So I'll just deal with those first. So bear with me 1 second. So first question is, what would you consider the key drivers of a move higher, or the key drivers to be for a move higher in sterling euro? Well, I think I've done sort of a reasonable job explaining here that I think if we saw the European Central Bank reopen the door to interest rate cuts, then certainly from a short-term perspective, that could put some pressure on the euro, because if you look at how market interest rates are expected to move over the course of the next year to 15 months, there is expected to be quite a significant closing of that gap. I think that another factor here is if the Eurozone doesn't pick up, if Lane is right, if the ECB chief economist Philip Lane is right, and he says that there is disruption to the transmission of monetary policy onto economic activity, then the ECB might actually have to follow suit as far as reducing interest rates are concerned, alongside what the Bank of England are prepared to sanction. One other factor is we still have a lot of political uncertainty in the Eurozone. So we've got problems as far as France are concerned. Even if they do pass this budget, they're passing a budget that's now delaying a lot of the much needed welfare reforms. So I'm not sure that that will play particularly in a particularly friendly fashion as far as financial markets are concerned. And then one final thing is that as far as the euro area is concerned, they do still face more elevated geopolitical risk from what's going on close to their borders between Russia and Ukraine. And so there are factors there that could play negatively for the euro. But I do think a lot of that is already priced for. I think that's already in the price as far as these current market rates are concerned. So hopefully that's answered that question. And if we move on to the next one. So we have, apologies for this, I'm just getting used to new technology here. So the next question is, if the government increases taxes in the upcoming budget, will that make interest rate cuts from the Bank of England more likely? That's a good question, because the honest answer is we don't know, because we don't know what that increase in taxes will face off against. If it is an increase in taxes that is not met with some greater fiscal responsibility on spending, then it does risk slowing down growth, slowing down investment, increasing job losses. And I think that could make an interest rate cut from the Bank of England more likely. There's certainly, when you look back to their August decision, I think they focused on what they were seeing as far as the slowdown in the jobs market was concerned. So definitely concerned by what we're seeing there. Bank of England as well might, and I say might, get happier with the trajectory as far as inflation's concerned. Nothing really here that the government necessarily directly influences, but I did mention about pensions rising by whatever the inflation rate was in this number, or by average earnings, whichever is largest. And we have seen a downward trajectory in both of those. The other element is, what will the national living wage rise by? And that will be something that the Chancellor announces in the budget as well. And so if there are signals in this that national living wage is increasing by less than perhaps the markets are expecting, then that could also be a significant influence on the Bank of England and potentially increase the chances of a rate cut. Now we've got another question here. Why isn't the government shutdown in the US having a greater effect on financial markets over there? Great question, and I do not know. Is the honest answer to it. I would have thought by now, given that we are seeing it have direct impacts. So, for example, I think it was yesterday, or it might have been the day before, Unilever said that they were delaying their spin-off of Magnum Ice Cream Company. So there was effectively a demerger of that particular part of the division, but they couldn't get the proper ratification on some of their statements from the SEC because of the shutdown. So that is a direct effect, and the market lost over that. There are other potential risks that I've already highlighted around retail spending going into the year end. So quite a lot of that, I think, is not being looked at by the markets, and it could be that from a stock market perspective, they're still sort of focused on the AI trade in terms of the additional investment that AI technology is going to require for all businesses. It might also be that because we've got no data, that they're kind of winging it in terms of what they're observing anecdotally. We do get some anecdotal data. We're going to get PMI data out of the US, the Eurozone, and the UK on Friday. And that might be sufficient, or seen as sufficient at the moment, to continue to hold US markets, whether that's equities, whether that's the US dollar, or indeed whether that's US treasuries, in a reasonably positive position. Now let me just see if we've got any further questions. I can't actually see any. We've got two apparently. Here we go. So the first one is, what do you expect the Bank of England to do with the base rate in November? I can answer that very quickly, which is nothing. I think that they will leave interest rates alone. I would be very surprised, even given the slew of data that we've got in the remainder of this week, if that would be sufficient to trigger another interest rate cut. And the reason I say that as well is because remember how close the vote was the last time around. It was effectively 5-4 in the end in favour of a 25 basis point cut. But 5-4 is a very close vote considering the trajectory that we've seen in the jobs market. As for the last question that I think we've got, any view of how sterling Aussie will trade over the next 12 months? I think I'll try and move it back to the slide that we had. There we go. That's the FX forecast slide. If we look at towards the bottom there, we do have some sterling Aussie forecasts. I mean, at the moment, above 2, and it had, I think it got up to a high of well over 210 at one stage in the immediate aftermath of the Liberation Day tariffs announcement. We have been on a bit of a downward trajectory thereafter. Obviously, Australia has quite a big tie to China, and there has been a significant intensification of US-China tariff talk, and so that might have a negative knock-on effect onto Australia. But overall, I do think that the Australian economy is in a better place economically, is going to grow somewhat faster than the UK, and therefore I would expect to see some downward track in sterling Aussie dollar down towards sort of 195 from current levels over the next 12 to 18 months. So hopefully that's answered that question. And we've got another one that's just come in. And it says, interesting to note the stronger dollar FX forecasts compared to many other forecasts. Appreciate this is based on the US economic fundamentals. Do we still need to build in a Trump-led uncertainty FX premium cost regarding tariffs? The answer to that is absolutely. It would not surprise me if we see further commentary from Trump that then pushes the dollar weaker once again. But I think the effect of each one of his comments tends to be less significant in terms of market action than the last. The markets are becoming somewhat insulated from these sorts of commentaries. So each time he says something, I think it has a lesser impact than the last time. And if, as we've seen with the China situation, is anything to go by, there does seem to be a bit of a walking back of some of the language even more quickly each time on tariffs or potential tariffs. So from my perspective, I don't think that we're going to see as big a market reaction as we've been seeing with regard to tariff announcements. One point to highlight as well, which I forgot about, is there is a very important ruling coming up. I think it's in the second week of November from the US Supreme Court on the US Court of Appeals ruling over those tariffs and their legality. So just watch out for that, because that could have a much larger market effect. And in fact, that could actually end up being dollar positive. Crystal ball question. Oh, good. I love these sorts of things. Is there likely to be a significant UK market correction post the November budget? There shouldn't be. I think a lot of this is well trailed. I mean, one thing that governments, past and present, are very good at is floating ideas to see how they are received both by the media and the general public as well as financial markets. So there's an awful lot already in the headlines that we've seen. So I'd be surprised if we get that many surprises out of this budget. So I wouldn't expect a significant market correction. I mean, there is obviously a risk if people don't think that the black hole has been filled in a responsible fashion, then that could create a market correction. But again, the government is sort of well prepared as far as all of the headlines are concerned, and all of the commentary that have been making their views known on the UK budget. So I would be very surprised if there's big market correction on that. And then I think we've got another question. Any thoughts on gold? Yes, I don't understand it. I think that's probably my the extent of my knowledge on gold. It's been on a real sort of push higher as far as the course of the last sort of 6 to 10 weeks. Broke through 4,000 and got very high thereafter that in terms of up to some $4,300 per troy ounce. There's a lot of factors, a lot of moving parts behind gold. One of them has been that central banks have clearly been correcting their FX reserves to take a larger share of gold as an FX reserve currency. But I don't see the fundamentals that keep driving gold higher beyond the age-old theory that you can buy it and sell it to somebody else for a higher price. That has run out to an extent. We've certainly seen that in terms of a big market correction over the last 24 hours or so. And the idea of buying gold clearly has been supported by expectations of lower interest rates. But given how priced in those interest rate cuts are, I don't get it anymore. I don't get why the gold price continues to rise. But as I say, I'm no expert on gold, so. And what is the risk of a downturn in the equity markets in 2026? Look, I don't know. I'm not an equity market analyst. I think if we get lower interest rates, people would associate that with higher equity valuations because you're facing off against a lower zero risk premium. But they've been on a very, very strong uptrend for a long period of time. So I don't see that there is the fundamentals, certainly not the growth fundamentals, to support a significant additional increase in equity markets. But I probably could have said exactly the same thing about 2025. So we don't have any further questions. I hope that's been interesting. I hope that's been informative. If you do have any questions that you want to raise offline, then please make sure that you reach out to your Moneycorp contact. And if you don't have a Moneycorp contact, there are contact details on the presentation. Thanks very much for joining us today. This is the first one that I've done here. I hope you found the session useful. We're going to be running these each month. So please make sure that you get subscribed to our Market Pulse, which is our daily market commentary. And that will also give you updates for when our next webinar will be. And we'll share a copy of the recording shortly. If you'd like the slides, we can also provide those with you. But again, reach out to your usual Moneycorp contact or give the team a call using the numbers on screen. And finally, you'll receive a short survey and feedback form from us. I'd really appreciate it if you could fill it in. It's only going to take you 5 minutes, but we want to know what we can do better, what you'd like to hear more of, and potentially also what you'd like to hear less of. So thank you very much for dialing in. It's been an absolute pleasure, and we look forward to seeing you again at next month's webinar. Thank you very much, and goodbye.